Imagine stepping into a world where your money can grow. You can watch it multiply and help you achieve your dreams. This is the exciting world of investing. Today, we're going to demystify 3 key players: stocks, bonds, and ETFs. Understanding these investment tools is the first step towards securing your financial future. Whether you're saving for a house, your dream vacation, or a comfortable retirement, knowing how to invest wisely is crucial. Let's get started. Think of your favorite company. It could be a brand you interact with daily, a service you rely on, or a product you can't live without. Maybe it's that coffee shop you can't live without, the one that fuels your mornings and keeps you going throughout the day. Or perhaps it's the online store you constantly browse, where you find everything from daily essentials to unique gifts. When you buy stock in a company, you're essentially buying a tiny piece of that company, making you a shareholder. This means you own a fraction of the company and have a stake in its future. As a shareholder, you share in the company's profits and losses. If the company performs well, you benefit. But if it doesn't, you share in the downturns too. If the company does well, the value of your stock goes up, and you can sell it for a profit. This is one of the primary ways investors make money in the stock market. However, if the company struggles, the stock value may decline, leading to potential losses. This is the inherent risk of investing in stocks. Stocks can be a powerful tool for long-term growth, but they also come with risks. It's important to understand that the stock market can be volatile, and prices can fluctuate widely in the short term. Diversifying your portfolio by investing in various stocks can help mitigate these risks. By spreading your investments across different companies and sectors, you reduce the impact of a poor performance by any single stock. It's also wise to seek advice from financial experts or do thorough research before making investment decisions. Educating yourself about the market and staying informed about the companies you invest in can make a significant difference. Today, technology has made it easier than ever to invest in stocks. With just a few taps on your smartphone, you can buy and sell shares, track your portfolio, and stay updated with market news. Remember, investing in stocks is a journey. It requires patience, discipline, and a long-term perspective. But with the right approach, it can be a rewarding way to build wealth and achieve your financial goals. Let's say you want to lend money to the government or a company. This is essentially what happens when you buy a bond. You are acting as a lender, and in return, the entity promises to pay you back the principal amount along with interest over a specified period. Bonds are a fundamental part of the financial world and offer a way for entities to raise capital without giving up ownership stakes. When you purchase a bond, you are essentially entering into a contract where the borrower agrees to pay you interest at regular intervals, known as coupon payments. These payments can be made annually, semi-annually, or at other agreed-upon intervals. The interest rate or coupon rate is determined at the time the bond is issued and remains fixed for the life of the bond. That's essentially what a bond is, a loan you make to an entity. Bonds are generally considered less risky than stocks because they provide a predictable income stream and return of principal at maturity. However, the level of risk can vary depending on the type of bond and the creditworthiness of the issuer. They offer a steady stream of income through interest payments, which can be particularly attractive for retirees or those seeking a reliable income source. The interest payments can help cover living expenses or be reinvested to grow your wealth over time. Different types of bonds are available, each with its own risk and reward profile. For example, municipal bonds are issued by local governments and often offer tax advantages, while corporate bonds are issued by companies and can offer higher yields but come with higher risk. Government bonds, such as U.S. Treasury bonds, are generally considered the safest because they are backed by the full faith and credit of the issuing government. These bonds are ideal for conservative investors looking to preserve their capital. On the other hand, corporate bonds offer potentially higher returns but carry slightly more risk. The risk level depends on the financial health of the issuing company. High-yield or junk bonds, for example, offer higher interest rates to compensate for their higher risk of default. Bonds provide stability to your portfolio and can be a good option for preserving capital. They act as a counterbalance to more volatile investments like stocks, helping to reduce overall portfolio risk. Including a mix of bonds in your investment strategy can help you achieve a balanced and diversified portfolio. tailored to your financial goals and risk tolerance. Imagine owning a basket of different stocks or bonds without buying them individually. That's the beauty of ETFs. ETFs are like packages of investments that trade on stock exchanges, similar to individual stocks. They offer instant diversification by investing in a pre-selected group of assets, such as stocks from a specific industry or bonds with similar maturities. ETFs are popular because they provide diversification, flexibility, and are generally more cost-effective than managing a portfolio of individual stocks. ETFs make it easy for investors to access a wide range of assets, making them an excellent choice for both beginners and experienced investors. Section 5: Stocks versus Bonds versus ETFs. A tale of three investments. Now that we've met our three investment heroes, let's see how they stack up against each other. Each of these investment options has its own unique characteristics, advantages, and disadvantages. Understanding these can help you make more informed decisions about where to put your money. Stocks are like the adventurous friend, offering potential for high growth but also carrying higher risk. When you invest in stocks, you're essentially buying a piece of a company. If the company does well, your investment can grow significantly. However, if the company performs poorly, you could lose a substantial portion of your investment. Stocks are ideal for those who are willing to take on more risk in exchange for the possibility of higher returns. Bonds are the more conservative friend, providing stability and consistent income. When you buy a bond, you're lending money to a government or corporation in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer than stocks because they offer more predictable returns. They are a good choice for investors who prioritize preserving their capital and earning a steady income. ETFs are the well-rounded friend, combining the best of both worlds, diversification and flexibility. An ETF, or exchange-traded fund, is a collection of stocks, bonds, or other securities that you can buy and sell on a stock exchange. ETFs offer the diversification of mutual funds with the flexibility of trading like a stock. They can be a great option for investors looking to spread their risk across multiple assets while maintaining the ability to trade throughout the day. Choosing the right investment depends on your risk tolerance, investment goals, and time horizon. If you're young and have a long time before you need to access your money, you might be more inclined to invest in stocks. If you're nearing retirement and want to protect your savings, bonds might be more suitable. ETFs can be a good middle ground for those who want a balanced approach. Remember, there's no one-size-fits-all approach to investing. Each person's financial situation, goals, and risk tolerance are unique. It's important to do your research and consider consulting with a financial advisor to develop a strategy that works best for you. It's about finding the right mix that aligns with your individual needs and financial aspirations. By understanding the strengths and weaknesses of stocks, bonds, and ETFs, you can create a diversified portfolio that helps you achieve your financial goals while managing risk effectively. Investing is not limited to Wall Street tycoons. You can start investing with small amounts of money and gradually increase your investments as your comfort level grows. For example, many employers offer retirement savings plans like 401ks that allow you to invest in stocks, bonds, and ETFs directly from your paycheck. You can also open a brokerage account and start investing in individual companies' stocks. The key is to start small, invest consistently, and watch your money grow over time. Starting your investment journey might seem daunting, but it doesn't have to be. Begin by setting clear financial goals for yourself. Are you saving for a down payment on a house? Planning for retirement? Identifying your goals will help you determine the right investment strategy. Next, do your research. Learn about different investment options, their risks and potential rewards. Consider your risk tolerance and choose investments that align with your comfort level. The world of investing is constantly evolving. Embrace the learning process and stay informed about market trends, economic conditions, and new investment opportunities. There are countless resources available to help you expand your investment knowledge, from books and articles to online courses and financial podcasts. Don't be afraid to ask questions and seek guidance from financial advisors. Remember, investing is a journey, not a race. Take your time, educate yourself, and make informed decisions. Congratulations on taking the first step towards securing your financial future. By understanding the basics of stocks, bonds, and ETFs, you've equipped yourself with the knowledge to start building a brighter financial tomorrow. Remember, investing is a marathon, not a sprint. Start small, invest consistently, and don't be afraid to seek help along the way. The most important thing is to start today. Your future self will thank you later.